Good day and a warm welcome to part 2 of the RBS Auditors Free Zone Tax Impact webinar. I'm Hannah, your host for today's session. Today's discussion will cover a wide range of tax-related topics, including the 13 qualifying business activities such as shipping, manufacturing, etc. Before we begin, we recommend reviewing Part 1 for a comprehensive understanding of the topics we'll be covering today. The link to Part 1 will be shared in the chat box by our admin team. Additionally, we invite you to explore past videos on our YouTube channel. Don't forget to subscribe, leave your comments, and share your feedback. We truly appreciate your support. Please note that for the sake of a smooth and organized session, the microphones and cameras of all participants have been disabled. Should you have any questions, please feel free to leave them in the comments, or you can mail us for any queries. It is now my pleasure to introduce our esteemed speaker, Mr. Sijin K. Ravi, FCA CFE, who is also a tax agent registered with the Federal Tax Authority, who will guide us through today's session. Over to you, sir.
Thank you, Hannah, for giving a brief introduction. Good morning, good afternoon, good evening. This is our 10th webinar series on corporate tax, and in this webinar series, we are mainly concentrating on free zone tax. This is a second part, and in this second part, we are mainly covering on industry-wise analysis. That means the 13 activities, qualifying activities we will be discussing, and these 13 activities will be discussed with the industry-wise. So let's schedule our presentation. So agenda today, first is we'll quickly go through the recap of the part 1 webinar series. And the second one is we'll go through the qualifying free zone person condition, what are the conditions. And the third one, we'll discuss about the 13 qualifying activities with the practical examples. So part 1, we have already discussed about the definition, what exactly it will be coming, then what are the tax rate for the free zone, whether it is a 0% or 9%. Then we'll come to the key condition like a juridical person, non-juridical person, then free zone person, then scope of the free zone tax. Then we have discussed about the SIGA like core income generating activities. Then non-eligibility criteria like SBR, that is small business relief, loss relief, then tax group relief. Then we discuss immovable property, then de minimis condition, and we have already discussed about the CT return content, what exactly you have to mention in each CT wise, what are the conditions, then all these things we are already discussed in the part 1 session. So if you haven't visited our first webinar series, or if you haven't attended one, please go through this one, because of this webinar you need a basic understanding. So first you should have a basic understanding of this one, then only you'll get a clear-cut picture. So we have already uploaded all this information in this YouTube channel. So you can go through that one and you'll get a better idea. So what are the qualifying free zone conditions? So Article 18, it says that there are 6 conditions you must be followed. If 6 conditions you must follow, then you can eligible for 0% tax. So what are the conditions? One is a substance, and second one is a qualifying income. Third one is a not elected at a 9% CT, and fourth one is a comply with the TP. Then fifth one is audited financial statement, and the sixth one meet de minimis requirement. So all these conditions we have already discussed in the first part, and we have already covered a lot of example with each area wise, especially for the substance. Then we have discussed with the election of a 9% tax. Then some of the areas relating to TP and audited financial statement. And we will be mainly concentrating on qualifying income. What are the income will be qualifying income. In that one, what are the qualifying activity? This activity we'll discuss in detail with industry wise. So first itself, qualifying income at 0%. So what exactly qualifying income? What are the income will be treated as a qualifying income? One is relating to transaction with the free zone person that are beneficial recipient and not related to excluded activity. So if you are conducting any transaction with a free zone person, that means your company is situated in a free zone and you are transacting with another free zone, but beneficial recipient is not a excluded parties or excluded activity. In that case, you will get. Then second category, It is relating to transaction relating to non-free zone person, but only with the qualifying activity. So if you are conducting any transaction with a non-free zone person, then you conduct only with the qualifying activity. So in that qualifying activities, it's a 13 qualifying activities specifically says that if you are conducting this 13 activity with a non-free zone person, that means you have a company situated in a free zone and you have a company situated in a mainland. So if you are doing a transaction with the mainland companies, if you are doing one of the qualifying activities, then you will be eligible for 0% tax. Third condition, income from ownership and exploitation of qualified intellectual property. Again, then it is a qualified intellectual properties items. Any other income provided that de minimis requirement are met. De minimis requirement, it is 5% or 5 million, whichever is less. That de minimis requirement you have to meet, then you will get the 0%, and the provision will be Article 3 of Cabinet Decision 100 of 2023. So this is the previous slide. This is relating to qualified income 0% tax. So this is an important one. Once you understand the concept thoroughly, then the entire free zone tax is relating to this part only. So first two slides, it is relating to 6 conditions. That 6 condition, out of that 6 condition, one condition it's relating to qualifying income. Then that qualifying income, there is a 13 activity. Then one more category, it is like whether you are doing within free zone or outside the free zone. If you are within the free zone, then it is not necessarily that you have to do with only the qualifying activity. These examples we have already discussed in the part 1 of the webinar series. So you can just go through, then get an idea about how it will be conducted. That point number 1, transaction with the free zone person. Now we will discuss about the qualifying activity. So Ministerial Decision 265, Article 2, it will explain about the qualifying activities. So what are the qualifying activities? There are 13 qualifying activities. One is relating to manufacturing of goods or materials, then processing of goods or materials, then trading of qualifying commodities, holding of shares and other securities. So first category, it is a goods or material. One is a manufacturing and the second one is a processing. Third one is a trading of qualifying commodities, including commodities items, then holding of shares and other securities. Then another category, ownership, management and operations of ships, reinsurance service that are subject to regulation, fund management services that are subject to regulation, wealth investment management services that are subject to regulation. Then next category, headquarters services related to related party, treasury and financing services to related party, financing and leasing of aircraft, distribution of goods or material in or from designated free zone. Then 13th one, logistics service. So these are the 13 qualifying activities mentioned in the MD of 265, Ministerial Decision of 265. So once you understand the concept, so either you do a business within the free zone, or if you are doing outside the free zone, then it should be with the qualifying activity. So this is a basic understanding of the free zone taxability. Wherever I have marked like a shaded portion, if these things are happened in through natural person, then it is not treated as an excluded activity. That means ownership, management and operation of ships, then fund management, wealth management and financing and leasing of aircraft. If you are doing any transaction with a natural person, then still this is treated as a qualifying activity. So what is the excluded activity? Now you will see the excluded activity. So whatever the shaded portion we have shown in the previous slide, it is like ownership management, fund management, wealth and investment, then financing and leasing aircraft. This is except those activity, whatever it is there, it is treated as excluded. Then banking. So any transaction with a natural person, with the banking, then insurance, then financing and leasing, then ownership and exploitation of immovable property other than commercial property located in a free zone like a hotel building, then any activities that are ancillary to these activities. So these are the excluded activity. So first, before carried out any taxability like either 0% or 9%, first you have to look into whether it is coming under any of the excluded activity or within the activity. Then you have to decide whether you are eligible for 0% or 9%. So we'll go by one. One is relating to manufacturing of goods or material. So it is applicable for manufacturing industries. So what is manufacturing? So manufacturing is a process that includes main areas like creation, production, improvement, assembly. So any creation or production or improvement or assembly of any product or raw material to the final product, then it is treated as manufacturing. It includes any conception of the product, like a capital investment, research and development, then procurement, then raw material procurement at the end stage of production. So whatever the production stages, like whatever the activities, even if it is at a planning stage, R&D work, or it's on a capital investment, all it is treated as a part of manufacturing process. That means it's only one part, it is all including. Then third part, it is relating to assembly. So if you are doing some assembly work, see, if you are manufacturing TV units and you are processing of that one, that means the packing of all these things or assembling of the entire TV, even still it is treated as a manufacturing of goods or materials. Then related to ancillary activities, like activities that may be treated as ancillary to the manufacturing of goods or materials, then it is treated as manufacturing activity. Then post-sale, customer support or installation, warranty and maintenance, all these activities are treated as ancillary. Ancillary activities are treated as a qualifying activity. So there is a qualifying activity, then corresponding qualifying activity, there is a ancillary activities. But if there is a repairs are there, then it is not treated as a manufacturing activity. So qualifying activities like production planning, quality control, testing, inspection, manufacturing of goods. So all these things are treated as a manufacturing of goods. And ancillary activity like a post-sales activity or customer support. So in simple words means whatever the manufacturing activity from the beginning to till the delivery and installation and warranty, all this is treated as a qualifying activity. So some activity will be qualifying activities, second activity will be ancillary activities. So you have to decide what type of industry you are located and whether it is covering under one of the activity. If one of the activity, whether it is treated as a manufacturing of goods or materials, then you have to decide then whether your industry is covering under that activity. So let us look at meaning of goods. So goods are tangible items produced or manufactured for sale or use. So what are the goods means? Tangible or intangible items. So tangible items like goods include clothing, food, electronic, furniture, cars, and ships. Even ships also a part of a manufacturing goods category. And intangible item other than software sold separately, like for example, physical phone. Physical phone with a pre-installed software, it is treated as a goods category. But if that same thing, ERP or automation of tools, that means the software sold separately, then it is not treated as a goods. So simple means whatever the goods items like a food or electronics, furniture, then cars, ships, everything is treated as a goods category. So the first definition itself, it's a manufacturing of goods, that goods category definition. Then we'll see that what is exactly qualifying activity and associated ancillary activity. So qualifying activity, it is necessary for the performance of the main activity, and ancillary activity means it makes a minor contribution to the main activity. For example, you are manufacturing a TV unit and you are doing some processing. Then after that processing, you are doing an installation or you are just doing a packing. So packing will be an ancillary activity, but main manufacturing of TV units will be a qualifying activity. So there is a qualifying activity, then there is an ancillary activity. So it is intercorrelated one. So if only the ancillary activity you are doing, then it is not eligible. So first it should be having a qualifying activity for main activity, then along with your ancillary activity. Let us look at the one example. The manufacturer performs SIGA and ancillary activities in a free zone. Company or a free zone person is engaged in the contract manufacturing of different type of furniture, such as table, chairs, and beds, only B2B transaction. So one is the main condition, B2B transaction. And P&L is given below. Sale of furniture, it's 7 million between free zone person and non-free zone person. Sale of scrap and waste material is 50,000 leftover wood items. Then after sale services, 70,000, installation and warranty, non-free zone person. So whether it will eligible for 0%. So first we will look at what exactly, whether the company is situated in a free zone location. So company is situated in a free zone location. And the second part, it is relating to what are the items. They are different types of furniture manufacturing, that like table, chairs, and birds. So this is a different items of manufacturing, and they are selling those items to the another B2B transaction. So all conditions are satisfied, then we will see whether company R is eligible. So total revenue of 7.1 million treated as a qualifying activity. Sale of scrap, that means a 50,000 leftover wood it's a part of ancillary activity, and 70,000 after sale service, installation, warranty, non-free zone person. So there is a condition we have discussed about the 4 qualified conditions. One is relating to within the free zone, or if you are doing an outside free zone, that means a mainland. But if you are doing a mainland transaction, it should be only the qualifying activity. So their qualifying activity is a manufacturing of goods. So installation, even if it is a non-free zone person, that means even if you are doing an installation at the mainland company, still you will be eligible because your qualifying activity is associated with ancillary activity. Let's see one more example. For example, the company is a cup manufacturing company in a free zone, and their customers are, one is a X LLC is a juridical person, Y LLC it's again a juridical person, and Mr. H is a natural person. So X LLC uses cup as a office suppliers. Then it is treated as a qualifying activity, B2B transaction. Again, Y LLC juridical person and resell cups to other person. Then it is treated as a qualifying activity. And another one is Mr. H, natural person, and use cup for own consumption, then it is not treated as a qualifying activity, automatically excluded activity. So main thing, we have to see that KYC of the customer is important for all this in order to get a 0% CT. So wherever you are selling, wherever your customers, know your customers is important, whether they are selling either to their own use or it is a resell to another, whether it is a B2B transaction, then you have to clear-cut understanding of the KYC of the customer is very, very important in order to get a 0% tax. Let's see one more example. Full-fledged manufacturer. Company yes is a free zone person engaged in the manufacture of advanced MRI machines at its own risk. That means a full-fledged manufacturing. Full-fledged manufacturer means from the beginning manufacturing process till the end of installation, support, and everything. That is called a full-fledged manufacturer. So we have already discussed in the transfer pricing area that a full-fledged manufacturer, toll manufacturer, then contract manufacturer. So this is a full-fledged manufacturer. They are manufacturing MRI machines. And company R sell MRI machines to company Y, a free zone person established in designated zone and engaged in distribution activity. And as a part of the sale of the company Y, it is agreed that any post-sale, that means after-sale service required by the end customer, such as installation, maintenance, etc., will be carried out by company yes. Because MRI machines are intricate and complex pieces of equipment that are require specialized knowledge for installation and maintenance of the property. So company yes is doing entire maintenance and service for MRI machines. And employees of company yes fulfill this obligation at the premises of the company Y, customers in non-free zone areas. Whether company is eligible for qualifying free zone person. So company yes is in the free zone, and company Y, again, it is another B2B transaction between free zone. And the second part, it is says that the after sale service is also included, and after sale services, it is included at Y. This is this company's customer's place. That means a non-free zone person. But this activity, it is in a qualifying free zone activity. Qualifying activity, one of the qualifying activity, it's a manufacturing. Then automatically, whatever the ancillary services also, it will be qualifying as a qualifying activity. That means if you are doing any transaction with the mainland, that means a non-free zone person, it should be a qualifying activity category. So the maintenance and installation and maintenance of MRI machines in the customer's place of Y's customer's place in the non-free zone location still it is treated as a qualifying activity. So the entire post-sale services closely related to qualifying activity of manufacturing should not be regarded as a separate activity. So it is treated as a qualifying activity. Now let us move to processing of a goods or materials. That means a processing industry. What are the processing industries? So what is the meaning of processing of a goods or materials? So processing means four categories. One is a preparation, then second one is a treatment, and third one is a transformation, and fourth one is a conversion. And conversion for further commercial or industrial use for sale. And this processing, after processing, the product remains the same. That means if the product having a different qualities, then this is not treated as a processing. And non-processing, like repairs, after processing a new product is created, then it is not treated as a processing. So if it is a simple preparation, treatment, transformation, conversion to the final product, then it is treated as a processing. So we'll see another example. Company W, a Free Zone person engaged in timber processing. It has 3 large factories in the Free Zone. So it is a timber processing unit. It is not a manufacturing, timber processing units. Company's core income is a business processing of timber generated 10 million in a revenue during the relevant tax period. Additionally, the same tax period, company W's other income. One is a rental income from unused factory space to another Free Zone person. That is a 700,000. Investment of portfolio income, investment of 82 million. That means 12 months holding period, it's 100,000. So whether company are eligible for qualifying Free Zone person. So let us look at the example. So 700,000, it is a 700,000, it's a rental income from unused factory space. This is a 10,000, it's a straight away, it's a qualifying activity because they are processing of the timber. And unused rental income from unused factory space to another Free Zone person. So this is neither a qualifying activity of processing of goods or material, but it is treated as one of the qualifying activity of commercial. That means you are doing a transaction with another Free Zone person with a commercial property, then it is treated as a qualifying activity, but not under processing of goods or materials. And investment income portfolio, it is 100,000 and the holding period is a 12 months holding period. That means a main criteria, it should be a 12 months period holding period. So dividend income will be treated as a qualifying asset activity, not under processing of goods or materials, but under dividend separately, it will be treated. That dividend will be a qualifying activity, holding of shares and other securities. So in your financials, whatever the income it is coming, you have to bifurcate whether it is under processing of goods or material, or whether it is under the commercial part, or it is under a holding of shares on other securities. So it is your financial, it is not like entirely, it is, for example, your industry is a processing units. It is not necessary that the entire activity it should be qualified under processing, but it may be qualified under other activity depending upon the nature of the transaction. That's why each transaction wise you have to analyze, and you have to analyze whether what type of transaction are you doing, whether that the KYC of the customer, whether you are doing with the another Free Zone person or individual. If this case is a rental income from unused factory space to another Free Zone person, if it is a other than Free Zone person, then it is automatically it will be taxed. It will be taxed at 9%. So that is the important thing. Here it is a Free Zone person. That's why there is a 0%. So main touch point, it is like a Free Zone. Second one, rental Free Zone person, it is only commercial. And third one, it is a Free Zone to Free Zone person, B2B transaction. And fourth one, investment portfolio, it is like a 12 months period holding. And investment, it is relating to different category of qualifying activity like holding of shares or other securities. Now we move to third activity, trading of qualifying commodities trading companies. So what is a qualifying commodities? Qualifying commodities like metal, minerals, energy, agriculture commodities, which is traded in a recognized commodities exchange market in a raw form. So if it is traded in a raw form, then only it is treated as a qualifying commodities. And raw form is a natural unprocessed state, like a minimal processing you are doing. For example, if you are doing for a minimal processing of a gold, raw gold, then you remove the impurity and formed into a bars or coins. Then it is treated as a standard weight with a purity and level. Then it is treated as a minimal process. Still, it is treated as a raw form. For example, other areas, it is like crude oil. So you want to remove the water and sand for impurity purpose. Then it is treated as a minimal processing. Then it is still treated as a raw form. And a qualifying activity include physical trading. So even if it's a physical trading of these metals, that is metal, mineral, or energy, or agriculture commodity, if you are doing a physical trading also, still it is treated as a qualifying activity. And the trading of associated derivatives used for hedge risk, then ancillary activity like warehousing, then commodity delivery, then all these things are treated as a ancillary activity. So it is not necessary that performed all these things through exchange. Even off-exchange transaction also treated as a qualifying activity, but underlying qualifying commodity can be traded in a recognized commodity exchange. That means even here it is metal, minerals, everything. It should be able to traded through a recognized stock exchange, even if it is not in a physical form. Even if it is in a physical form, still it is treated as a qualifying activity. See one example. Company X is a free zone person engaged in the trading of metal. So metal is one of the qualifying activity. It has a strong relationship with the aluminum manufacturer that produce high-grade aluminum for various industries. Market price for aluminum is AED 9,500 per ton, and company X negotiate to buy 10,000 tons at a slightly discounted rate of 9,250 per ton. Company X find a buyer in the automotive industries who needs a large supply of aluminum to produce a car parts. The buyer agrees to purchase 10,000 tons of aluminum at a current market price of 9,500 per ton. In addition to the above, storage and warehousing 15 per ton, delivery services 10 per ton. Can a company X claim qualifying activity for 0%? So first we will see whether this company X is a free zone person or not. He is a free zone person. And the second one, it's a factory, and it is a market price. Aluminum, they are used for 9,000 per ton, and the company has negotiated to buy 10,000 tons on a slightly discounted rate. So it is a commodity item, and they are selling to another free zone person. So revenue 9,500 into 10,000, 9.95 million. Then a storage of warehouse 15 per ton. Then delivery services income 100,000, so 95.25 million. So the entire activity is treated as qualifying activity. So revenue of 95.25 million will be treated as qualifying activity. So what are the checkpoints? One is relating to trading of metals. It is one of the qualifying commodities. Second one is a free zone. It is the company is situated in a free zone to free zone person. Third one, buying and selling of physical trading of metals. And this metal can be traded in the exchange also. That's condition also satisfied. So all these conditions are satisfied, then it is automatically this company will be eligible for 0% CT. Now we will see holding of shares and other securities. So what exactly means the holding of shares? That means the shares of any class in the share capital or other type of equitable interest. That means that they will get the profit, or at the time of liquidation process, the entire proceeds, whatever the shares he is having, he will get the liquidation proceeds also. So that type of shares, either it is in shares in the partnership firm or shares in the company or whatever it is, that holding of shares, whatever it is there, that investment part or income received, then that will be qualifying activity. So negotiable and non-negotiable financial instruments, including derivatives, financial commodities, cryptocurrency, and other instruments that or can be traded in public or private market. So even if it is a cryptocurrency, if it is traded in public or private market, then only it is treated as a qualifying commodities, qualifying shares and securities. Exclusion, what it is excluded. Any financial investment instrument that are issued in pursuant of securitization. So if you are giving as a security for receivables, then it is not treated as a qualifying securities. Then royalty and management fees, then active trading of shares or security not held at least 12 months. That means if it is a less than 12 months, then it is not treated as a qualifying commodities. So holding of shares or securities for investment purpose, in some cases like a major shareholder holding a shares in a company for investment purpose, and for investment purpose, they will get the shares of profit plus as a royalty or management fee in addition to that one. Then in that cases, this royalty or management fee is not part of a holding of shares or other securities. And it is understood that whatever it should be traded in a recognized stock exchange and it deemed that a transaction is not made with a natural person. That means if it is a recognized stock exchange, it should not be with the natural person, and it will be treated as a qualifying activity. And another condition, it should be ownership must be there for 12 months. Ownership must be there. That 12 months testing should be satisfied. So if 12 months it's not holding for a 12 months period, then you will not be eligible for this holding of shares or securities. Whatever the income received, it will be taxed at a 9%. So let's see one example. Holding company H is a free zone person holds a diversified portfolio shares of other securities for investment purpose. So it's a one category they holding for investment purpose. During the relevant tax period, company Y receives a dividend of AED 1 million from the shares that have been held for less than 12 months. So here it is saying that less than 12 months, it is not eligible. But however, company H is intention to continue holding of shares for more than 12 months. So there is an intention to hold for more than 12 months. A dividend of 1.5 million from membership interest in the limited partnership that has been held for more than 12 months. So share capital in the another partnership firm. Then capital gain of 2.5 million on sale of shares that have been held for more than 12 months. More than 12 months, one investment shares has been sold. Then they got a capital gain of 2.5 million. Then interest of AED 250 from investment in bonds that have been held for more than 12 months. So if you see all these categories, here it is a 12 months, more than 12 months, and here it is more than 12 months, here it is more than 12 months. And the first category, it is 1 million in that intention to continue hold of shares for more than 12 months. So there is an intention. So the entire revenue will be treated as a qualifying income. That even though the intention, there is a clause saying that there is an intention. So you have to show that what is an intention. You have to clearly show that one, then automatically it will be treated as a qualifying activity. So one more thing, there is a clause saying that a shares and other security for investment purpose. If it is just for a short-term profit purpose, then it is not treated as a qualifying activity. It is not a part of a holding of shares or security. For example, financial recovery. Company D, a free zone person, purchased 100% of shares in company A for AED 1 million. After the purchase, company D discovered that company A had a certain undisclosed liabilities negatively impact the value of shares. Company D litigates the issues and the court rules in favor. The court awards company D AED 200,000 in financial damage for original owners of the company A. Can company D claim a qualifying activity for CT, 0% CT for financial damage? So there is a company D, then company D purchased 100% of shares in company A for AED 1 million. So then after purchasing these shares, then only they noticed that there is an undisclosed liability negatively impact the value of its shares. So in that case, they have filed a case against a company. Then they got a 200,000 as damages, original owners or to the company A. Then this is, even though 1 million is not part of this one holding of shares or securities, then still it is treated as a part of qualifying activity. So if it is a similar treatment in case of an indemnity claim, even if it is directly purchase or sale price, it is not related to that one, still you will get indemnity claim or something like that, then still you will be treated as a part of a qualifying activity. So 200,000, whatever 200,000, whatever the income received, it is treated as a part of a qualifying activity. Now let's move to ownership, management, and operation of ship. So this is applicable for mainly for shipping companies. So what are the conditions? So one is ownership, management, and operations of ship used in. One is the main condition. It should be international transportation of passengers or goods or livestock. Then offshore or oil field and maritime services, that oil drilling, seismic service. Then leasing and chartering of ships on a bareboat basis of the above ships. Then towing activities. Then provision of general assistance to ship at sea. Then dredging activities at sea. Then activities ancillary to the above, which include broking, organizing, and overseeing voyages. So these are the activities. So the main condition, one is the ownership. Ship must be owned, then managed and operate. These three conditions must be satisfied in order to get 0% eligibility. And what are the excluded category? If it is for a local transportation, that in between, for example, from Dubai to Abu Dhabi, local transportation, it is not treated as a ownership, management, and operational ship. Then leisure, then floating hotels, restaurant, casinos, then leasing of shipping containers. So all these activities, it's an excluded category. Then one more thing, transaction with a natural person are not excluded activity, because the first slide, whatever I have discussed in that one, I have shaded some of the areas. So one of the areas like ownership, management, and operation of ship, even if you are doing a transaction with the individuals, then it is not treated as an excluded activity. It is still treated as a qualifying activity. So what is international transportation? Even if a movement of a goods or person beyond territorial waters, for example, from Dubai, the ultimate destination is in Australia. So from Dubai to Abu Dhabi, then from Abu Dhabi to Australia. So from Dubai to Abu Dhabi, still it is treated as an international transportation. So usually it will be, if it is this one, even if it is a local transportation, but it is not treated as a local, but it is straight away it is treated as an international transportation, because the ultimate destination, it is in Australia. It's a through passage it is going, so that's why it is treated as an international transportation. See one example. Company F, a free zone person involved in ownership, management, and operation of ship. Following are the additional revenue. Demurrage charges 22,000 per day for 50 days. Then standby charges 20,000 per day for 20 days. Then additional war risk premium for 3,000 per voyage for 100 voyages. Then heating charges 500 per day for 100 instances. And standby charges, it is like 20 days when the vessel was instructed to wait for loading or unloading of cargo. So they charge 20 days for 20,000 per day. So this is 1.8 million. They charge, total revenue is 1.8 million. The entire revenue, it is treated as a ownership, management, and operation of ship, qualifying activity. So what are the touch point you have to see? Whether the company is on the ship. So here it is itself, it says that the company are free zone person. So second one is whether the company is situated in any of the free zone. So company is situated in a free zone. And second thing, ownership, it is in the ownership in a company F. Then company F is operating the entire ships. So automatically ownership, management, and operation of ship, everything it is carried out by company F. Then automatically it is one of the qualifying activity. Then it's closely related to qualifying activity. Then automatically they will be eligible for 0% C. Then second example, company G, a free zone person, owns and operates a fleet of semi-submersible drilling rigs and drilling ships. And it offers services related to oil and gas drilling, well intervention, decommissioning. It also operates offshore construction of vessels that carry out a heavy lift operation and help construct oil rigs and platforms. So whether the above activity is treated as a qualifying activity. So company G's operation. So first it is a company G. Ownership, it is with the company G. Then operation, it is located in the free zone. Third one, whether the activity it is like offshore oil field and maritime business, maritime services. That means oil drilling, seismic survey, everything. It is one of the qualifying activity of ownership, management, and operation of ship. So everything it's satisfied, then automatically the company G will be eligible for 0% CT. Next example, maintains adequate substance. So company yes, a free zone person owns and operates 5 ships. So here it is owns and operate 5 ships. transporting passengers from the UAE to Oman. Company yes manages a crew for the 5 ships from its head office in the free zone through team of 3 supervisors led by a manager. Core income generating activities. Management of a crew is from the head office in the free zone. Company yes is also conducting technical management of 5 ships from the head office in the free zone. Regular maintenance is conducted in the shipyard located in the free zone. Then and separate 2 dedicated experienced engineers are allotted for these services. So can company yes claim qualifying activity for 0%? So what are the touch points? One is relating to ownership. Company yes owned 5 ships. So ownership it is already satisfied. Second one, operation it is carried out by company yes. Then activity, it is relating to international transportation because from the UAE to Oman, it is international transportation. It is not a local transportation. If it is a local transportation, then even if you own the ships, then you will not be eligible. And next one, activity, transportation of goods or passengers. Then they have qualified employees to look after the experienced engineers for the repairs and maintenance. Then there is a technical management team for managing the entire operations of the ships, that is managed from the head office in the free zone. Again, it is in the free zone. So all substance category it is satisfied. Then the qualifying activity conditions are satisfied. Then company is situated in the free zone. Then automatically the company yes will be eligible for 0%. So core income generating activities it's already satisfied. Let's see what happened if it is an outsourcing. Company X is a free zone person, owns and operates ships used for international transportation of passengers across GCC countries. To address the shortage of the staff, Company X outsourced the management of the crew for a newly acquired ships to the Company Y, a company incorporated in the same free zone and specializing in recruitment and service and HR management. Can company claim 0% CT? So activities outsourced to company Y treated as performed by the company X for the purpose of meeting adequate substance requirement. Company X will need to demonstrate. So what company has to demonstrate whether whatever the activity conducted by this team, that means company Y, it is situated in same free zone and they are giving a supply of HR related services to these companies. So they have to ensure that company Y has a sufficient number of qualified full-time employees. So first, company Y, whether they have full-time sufficient qualified employees available for operating this ship. If it is yes, then it is fine. Second thing, 2 managers from the company X. These 2 managers from the company X represent a qualified full-time employees to look after these outsourced employees, whether they are following all this transaction or whether they are doing the entire work, the operations of work. If all these conditions are activity, that means closely operating the activity, closely monitoring the activity, then it is still they will get a 0% CT. That means one is ownership is there. Second one is operation of company. It is operation of the company situated in the free zone and whether they have adequate supervision. Here it is adequate supervision is there, and here whether they have supplied a qualified full-time employees to company X, that's also satisfied. Then automatically company X will get a 0% CT. We'll see international cruise line. Company H is a free zone person, is a cruise line that operates in a fleet of ships, offers round-trip travel package between ports of Dubai, Abu Dhabi, Doha, and Manama. Passengers can enjoy multiple specialty restaurant shows and enjoy other entertainment amenities as they travel back to their point of origin, whether above activity is treated as a qualifying activity. So if it is a local transportation, this is not a qualifying activity, but this one, it is going to Doha, Manama. So it is an international one. But another one, it is like restaurant, casinos, then whatever the shows, whatever it is there, then it is one of the excluded activity. But if this is a part of the entire trip, then it is not treated as a excluded activity. then automatically company H is engaged in the qualifying activity of ownership, management, and operation of ship. That means that they having a fleet of ships. That means that the company is on the ships. Then that condition. Second one is the management. Management is done by company H. Then third condition, it is an international transportation of passengers. So that is satisfied. Then fourth condition, it is the activity, whatever the activity, because it's relating to the restaurant, then casinos and everything, it's a part of the journey, then it's a part of the final destination, then it is still it is treated as a qualifying activity. Because even if you take it as single, if it is in a local, all these transaction it is treated as a local transportation, then automatically it is treated as a excluded activity. But in this category, even if restaurant services, then other entertainment services, still even though this is our excluded activity, but it is a part of the journey, then automatically it is treated as a qualifying activity, and they are eligible for the entire transaction, eligible for 0% CT. And even second, another category, if a transaction with a natural person for a shipping, it is an qualifying activity. It is not an excluded activity. And one more category, ticket agents for international cruise. Company X is a free zone person, is a ticketing agent that sell cruise package as an agent for various cruise lines. Company X receives a commission for each package that it sells. Then whether the above activity is treated as a qualifying activity for CT purpose. One is company X derives income from cruise line and not from individual. So company X commission from another company, so not from the individual. And the company X is not itself engaged in ownership management. So in this category, company X is a free zone person, but a ticketing agent. But this ticketing agent, they are only cruise package they are selling, and they are not on any ships. In this scenario, company X will not get any benefit of 0% CT. But if the company is situated in one of the qualifying free zone, and if they are doing a transaction with the free zone authority, free zone companies, then automatically they will be eligible for qualifying free zone status. Now we will move to the next category, reinsurance services, insurance companies. So what are reinsurance services? So reinsurance services means a reinsurance operation that are regulated under Federal Law number 6 of 2007. That means the activity assuming all part of risk undertaken by another insurer or reinsurance. That means you are insuring your insurance with another reinsurance, then that activity is treated as a reinsurance policy, then that activity is treated as one of the qualifying activity of reinsurance services. And all these services must be subject to regulatory oversight. That means it must be regulated by insurance authority or any authority prescribed by the respective free zone. And what are the services including underwriting, subrogation recoveries, that means recovering some of the money paid out of the claim, then claim handling or management, loss adjusting, investing activity, actuarial services, risk management. So all this activity, it is a part of the reinsurance services. So it specifically says that the insurance with another reinsurer, that means a B2B transaction only, not B2C transaction. So let's see one example. Company K is a free zone person, provides the insurance services to a primary insurer, also provide insurance directly to customers. That means insured person. The arrangement. So company K is a free zone person and directly to another primary insurer. That means here it is a reinsurance. Then they are doing another insured person. That this activity, like they are getting the insurance premium and everything. It's not relating to the companies or personnel on. It's a reinsurance service, not a reinsurance service. That means directly you are insuring. For example, you are doing a car insurance. So directly doing a car insurance services plus reinsurance services. So there are two activities. So one is relating to reinsurance and the second one is relating to direct insurance. So the first category, like a reinsurance premium, this part will be automatically treated as a qualifying activity, and this part will not be treated as a qualifying activity. This is not a qualifying activity. So if you remember, out of the 13 activity, it specifically says that a reinsurance business subject to regulation, and second category, a reinsurance business to business, B2B transaction. So what are the touch point here to see whether the company located in the free zone? Yes, company is located in the free zone, and they can do a transaction either with the free zone or UAE mainland or foreign. It is doesn't mean that which location. So even if you are doing a business, reinsurance business with the mainland, or insurance with a foreign company, or reinsurance with another location, then still they will be eligible. So main criteria, whether they are doing a reinsurance business with the other party. That is the main criteria. Let's see one example. Company M, a free zone person, is engaged in reinsurance services. It has a contract with company Y that provides automobile insurance to cover certain claims over 50,000. One of the company Y's insured a customer, Mr. Serge, get into a car accident causing a significant damage to his car valued at 100K. As per the reinsurance agreement between company M, reinsurer company Y pays Mr. Serge the full loss of amount, that means 100,000, and recovers AED 50,000. So he will get, Serge will get 100,000 K, and because of the reinsurance part, they will get 50,000 from company M. So later so this is the first situation. Then later the company Y insurer managed to sell the damaged car in a salvage auction for AED 15,000. The salvage recovery of AED 15K is agreed to be split between both the companies, because both the companies are sharing that one. That means 7,500 to company M and 7,500 to company Y. And in addition to that, discovered that the accident was fault by third party. Company Y insures that fault of the party and awards another 10,000. So this 10,000 also, that means it's a claim against this third party. Subrogation recovery is also treated as a part of reinsurance business. Then that entire 10,000 will be divided into company M and company Y. Then the entire amount, 7,500, then 5,000, it is treated as a part of reinsurance business, because even though this company M is not directly involved into company Z, company M having a direct relationship with the company Y, and company Y have a direct relationship with Mr. So there is no direct relation between company M and company Z. So whatever the reinsurance premium, so 50,000 reinsurance premium is taken from company M. Then out of the salvage, whatever the auction, whatever the amount received, then both the companies shared. Then the end 7,500 and 5,000, it is treated as a part of a reinsurance business. So what are the touch point? One is a free zone to free zone person. Then second one is a direct, whether any direct insurance to individual or company. There is no direct insurance to individual and company. There is only a reinsurance business. So automatically company M will be eligible for reinsurance business, and their activity is treated as a qualifying act. Now let us look at fund management services, qualifying activity 7. So what are the core income generating activity? One is relating to portfolio management, investment and planning strategy, risk management, investment diversification, then discretionary and non-discretionary fund management services, day-to-day operation of the fund, and subject to regulatory oversight. So whatever the activity here mentioned, it should be a subject to regulatory oversight, and then automatically you will be eligible for fund management services. So financial advisory to the client, then training and education, then financial planning, technical support, all this treated as a part of a fund management services. So main qualifying activity, if the free zone person is appropriately regulated by an investment fund manager or investment advisor, that must be subject to regulatory oversight. That means either by the competent authority in the UAE, like a Central Bank of United Arab Emirates, or Dubai Financial Service Authority, DIFC, or DFSA. That's a regulatory authority. So all these conditions are satisfied, then fund management services are treated as a part of a qualifying activity. So let's see one example. Company P, a free zone person, is is an investment management company. So one condition, fund management company with a total of AED 50 million asset under management. Company P manages a special fund that focus technology stock worth AED 10 million. They realize they lack up-to-date expertise in the cryptocurrency sector, which they consider crucial for the fund performance. So company P decided to delegate the management of 20% of this fund, equivalent to 2 million, to cryptocurrency specialist. Company Y, a free zone person, charges 1.5% fee for the managing of the portion of this fund. So the cost incurred by P for this delegation total, it's 2 million into 1.5%, it's 30,000. So revenue from 30,000 received by company Y for providing the expertise on the cryptocurrency sector will be treated as a qualifying activity. So in this case, you can see that it is a fund management business, management of investment fund. Second thing, they have delegated this fund, almost a 10 million fund. Out of 10 million fund, 20% fund has been delegated to another company, which is again, it is a B2B transaction. That delegation, it is one of the qualifying activity of fund management. So automatically, company P will be eligible for 0% city. Wealth and investment management services. So what exactly wealth and investment management services? Wealth and investment management services includes, it's not only relating to just for an investment, it is relating to entire person's financial life, like relating to the wealth of the entire person plus the investment part. So it will include discretionary and non-discretionary investment management and advisory services, portfolio management, wealth investment, retirement planning, estate planning, all these categories. So all these things are included, then automatically it is treated as a wealth and investment management services. Then whatever the income received relating to wealth and investment management services treated as a qualifying activity, and 0% tax will be applicable. So for example, company R, a free zone person, was established as a single family office, private standalone business entity, exclusively manage financial and personal needs of a single family. So it is a purely on a privately owned company and privately owned business. Then company R is not regulated by relevant competent authority. So it is a one condition, R is not regulated by the competent authority. So company, if R is not regulated by the competent authority, then automatically wealth and investment management service is not treated as a qualifying activity. So one is a regulation must be there, then only automatically it will be treated as a qualifying activity. Then another example, company yes is a free zone person established as a multi-family office. So in this case, a multi-family office, like a private, standalone and business entity, to manage the financial and personal needs of a number of families. And if it is regulated by competent authority, then automatically whatever the income received on this fund will be automatically treated as a qualifying act. Now we'll move to headquarters services to related parties. So what are the services treated as a related party one? Headquarters services to related party include provision for specific services to resident and non-resident related parties, either to resident or non-resident related parties, either as a administration or overseeing managing of business activities, provision of senior or general management services, captive insurance services, procurement services, and general incurring, then expenditure on behalf of related parties. Related parties, its simple meaning, it is limited to juridical person and branches, or juridical person as a part of transfer pricing profession. Whatever the juridical person mentioned, that will be treated as a related party for this purpose. For example, company T is a free zone person, is a headquarters for multinational coffee chain with a franchise subsidiaries across the globe. Company T provides a variety of services such as strategic planning, marketing strategies, HR and financial management, and quality standards to every franchisee. Company T charges a single bundled fee based on the percentage of each subsidiary's revenue to cover the use of the brand name and all support services. Apart from these services, headquarters also procures and distributes its own proprietary coffee blends, which are supplied to the subsidiary globally, ensuring the taste and quality consistent across the chain. These are not charged within the bundle services fee. Instead, they are sold as a subsidiary as a goods at a separate prices. So company T, it's a free zone, headquarters in multinational coffee chain. Then it is a free zone person, not in a designated zone, and subsidiary. So whatever the portion of services, it is treated as a qualifying activity like a planning, marketing, strategy, HR and financial management. It is treated as a qualifying activity relating to RP. But if it is a portion of goods, it is not a qualifying activity. Whatever the portion of goods, it should be through designated zone. It is not a part of qualifying activity of headquarters services. So rendering of headquarters services would be treated as a qualifying activity, or selling of goods would be treated as qualifying activity if distribution only if performed in a designated free zone. That we will discuss in the another qualifying activity, then you will get a clear-cut picture. Treasury and financing services to related party. So what are the treasury and financing services? It includes cash and liquidity management, debt management, financial risk management, centralized payment and collection activities, cash pooling. And what is a related party? Related party, whatever the related party definition as per the transfer pricing, that means limited to juridical person, branches and juridical person as per transfer pricing portions. Then scope extended to foreign or domestic permanent, that means a foreign PE or domestic PE, and including self-investment. Shareholders loan falls within the scope of financing services. There is no threshold for this qualifying activity. So transaction between related parties should be compliant with the arm's length price. So this transfer pricing must be followed. Then if you are doing any of these services, then it is treated as treasury and financing services to related party. So let's see one example. Company U is a free zone person, deposits a working capital in an interest-bearing bank account and derives interest income of AED 10,000. So there is an interest-bearing account. Company U, it's a free zone person. Then they deposit. Then whatever the income received for the out of this deposit, it is treated as a automatically treated as a qualifying activity. So qualifying activity of the treasury and financing services. Next one, company V, a free zone person, is a multinational company that has a head office in the UAE Free Zone. Company V renders treasury and financing services to its subsidiary in a country A and country B. So there is a financing services to subsidiary country A and in country B. It maintains and operates centralized cash management system. So centralized cash management system is maintained in company V, and RLLC is subsidiary in a country A, and CLLC is a subsidiary in a country B. RLLC having a sufficient fund, surplus fund of 2 million, and CLLC having a deficit cash shortfall of 1.5 million. So 1.5. So instead of borrowing fund from the external party, what CLLC assesses the surplus of RLLC via centralized pooling managed by company B. That means the transfer of funds to the central pooling system, company V. Then from that company V, it transferred again to company C. So this is a headquarters. This is a related party services. So cash pooling is one of the qualifying activity. Then automatically this cash pooling system will be treated as a qualifying activity. So RLLC transfers surplus funds to the master account, which fund deficit of CLLC. So automatically company V is performing a qualifying activity in relation to treasury and financing services to related parties. So automatically company V is the centralized pooling system. In that case, whatever the fund given to CLLC, it is treated as one of the qualifying activity, and here also qualifying activity. So all these transactions must be routed through the transfer pricing regulation, and if it is an arm's length price, then only all these transactions will be carried out and treated as a qualifying activity. Financing and leasing of aircraft, qualifying activity 11. So what are the activities treated as financing and leasing? That means the financing, leasing, securitization of the above. That means securitization of the aircraft, then subleasing, granting and right to use, agency services, procurement, sale, leasing, then aircraft engine, rotable components, and ancillary activities like credit analysis, then portfolio management, disposal or sale of aircraft or any part thereof, then asset management. So financing and leasing of aircraft services provided to natural person is not an excluded activity. So whatever we have discussed in the initial slide itself, natural person, with financing and leasing aircraft, it is not an excluded activity, and a 0% corporate tax you will be eligible. So let's see one example. Company W, a free zone person, is a lessor that provides financing to an airline to acquire aircraft and aircraft engine in the form of finance lease. The financing is secured over the aircraft and aircraft engine. The arrangement is illustrated below. So the main lessor, that means intermediate lessor, is in the free zone. Then that free zone is providing the financing for purchasing of the aircraft. But this fund has been borrowed from the bank. That means a free zone, another bank, then another bank to the head lessor borrow of another free zone, then that free zone to the intermediate free zone. So the transaction between the bank and head lessor, it is not treated as a part of a financing activity. This is a part of banking activity, but this banking activity is one of the excluded activity. But here, whatever the provision of loan by the bank, it is not treated as a qualifying activity, but provision of financing between the intermediate company W and the airlines, it is treated as a qualifying activity. That means operating of financing lease. Another example, company B, a free zone person is engaged in the business of leasing and financing aircraft. Is at the conclusion of the operating lease, company B decide to sell an aircraft that it had previously leased. So if you already enjoyed a qualifying activity, then after that the lease period, automatically they are selling those aircraft, then automatically it is treated as a qualifying activity. So as the company B is the owner of the aircraft and aircraft was used in the company's B business, revenue from sale of aircraft will be considered arising from a qualifying activity. So whatever the ancillary or whatever the activity related to this transaction, then automatically treated as a qualifying act. Now we will move to distribution of goods and materials. So this is a major area, trading and distribution of companies, core income generating. Most of the companies are come under this picture. So let's see what exactly distribution of goods and materials. So distribution of goods and materials in or from a designated free zone to a customer that resells such goods or material or part for sale or resale. That means the customer should not be an end user. So the customer should not be an end user, then the whatever the goods or material must be only routed through designated zone, then only you will get this benefit of qualifying free zone benefit of 0%. So what are the conditions? That means the activity of distribution or goods or material must be undertaken in a designated free zone. So first condition, it must be whatever the goods or material must be taken in a designated free zone. Yeah, you can see the previous first webinar, we have already discussed what are the designated zone and what are the non-designated zones. So, and there is an FTA guidance note, there is a separate list of what is a designated zone. In case of import, it shall be routed through designated zone. Distribution typically include process of transporting of products from manufacturers, storing them and selling them in a different stores and customers. Then distribution of services related to customer that further resell or person that process the goods or material part thereof for the purpose of resale. That means he use for a resale purpose. That means only through B2B transaction, then only you will be eligible for 0%. If the goods or material are distributed to end user, such as the activity will not be treated as a qualifying activity. So it should not be an end user. If it is used for an end user, it will not be treated as a qualifying activity. So the documentation relating to the customer wise, whether it is very important, KYC of the know your client, it is important in order to get a 0% CT. Distribution of goods. A free zone person that is engaged in the activity of distribution of goods or material must conduct a necessary due diligence, such as know your client, seeking confirmation by way of undertaking a contract and ensure that not the end user. So even you are doing a 0% CT, then you have to ensure that that company is not an end user. And within the scope of qualifying activity, following are the purchase and resale of a goods or material, warehousing, transportation, delivery. That means all related activity like inventory management, order processing, package and repackaging. All these activities is treated as a distribution of goods or materials. So ancillary activity like repackaging, then marketing services, advertising, quality control, then inspection and customer support services, all ancillary services are treated as a part of a qualifying activity. That means your ancillary services means you are giving only minor contribution to the main activity. Then it is treated as a qualifying activity. So who is an end user? If the goods or material or distributor customer, that the end user, that means use or consumes the product, then such activity will not be treated as a qualifying activity. If the customer is an end user, if it is an yes, then it is not treated as a qualifying activity. If it is no, then distribution of goods or material will be qualifying activity. But they have to maintain other conditions like it must be a KYC must be maintained, then it should be in a designated free zone. If it is in a non-designated free zone, then it is not treated as a qualifying activity. For example, in a compared with the DMCC and JAFSA. So JAFSA is a designated free zone, DMCC is not a designated free zone. So if you are doing a transaction, similar type of transaction with DMCC companies, then it is not eligible for 0%. It will be attached at 9%. But if it is in a designated free zone, then it is treated as a qualifying activity. So distribution of goods within UAE or exports, then imports, then high sea sales. That means a cross-border transaction. So if the goods within UAE or export, that the goods or material already in UAE, then need not be in designated free zone, then activities must be performed in designated free zone. We'll discuss in detail about one of the examples, then you'll get an idea. Import. Goods or material should be either entered to UAE via designated free zone, that means through import, then activities are performed in the free zone, designated free zone. Then high sea sales, that means a cross-border transaction. Goods or material are not entering into UAE, but activities are performed in designated free zone. So if you see within UAE or export, within UAE or export, or high sea sales or export, so you can see goods or material are already in UAE. So here it is goods or material are already in UAE. That means that somebody has been imported that goods through the free zone, designated free zone, or whatever the areas. And here, high sea seal, goods or material are not entering into UAE. But here, this case is not entering into UAE, but all activities are performed in designated free zone. Then it is automatically you will be eligible for 0% CT. Let's see one example. Company C is a free zone person in a designated zone that buy goods from its manufacturer in a country A, India, and sells these goods in a retail distributor in a country B, China. Company C earns in a profit on the goods sold to retail distributor in a country B. The goods are shipped directly from the manufacturer in the country A to the retail distributor in the country B. The arrangement is illustrated in the following diagram, whether the company C qualify for qualifying activity under city. So country A, so the company C, it is in a JAFSA. Let's see JAFSA free zone. So it is a designated free zone. What are the touch point? One is a free zone, designated free zone. Substance, he has to show the substance. Then second one, it is whether it is a B2B transaction. It is a B2B transaction because one country located in a country A, then another one is a country located in country B, B2B transaction. Then there is a qualified employees and other condition they have to satisfy. That initial we are told that a 6 condition, all other condition if they satisfy. So purchased by company C, but the goods purchased from country A, that is a manufacturer, but the goods are not imported. Instead of that one, the company C told company A, manufacturer A, to move the goods from country A to country B without enter into the UAE. So in this transaction, basically it's a cross-border transaction. Still, you will be eligible for 0% CT, provided that all other conditions are met. That means all employees, qualified employees, and then free zone conditions, all other 6 conditions, if they met, then still you will get 0% city. So company C perform the activities in or from designated zone, then all activity, operation, arrangement involves. Then company C performing a qualifying activities. Company D is a free zone person in a designated zone. So one condition, touch point, one is a designated zone. So already automatically qualify for the 0%, eligible for 0%. And that buy goods from a country A, Germany, and sell these goods to the retail distributor in the UAE. Company D earns a profit on the goods on a retail or distributor. The goods are shipped by the manufacturer in a country A to company D in the designated zone from where they are imported into the UAE. So let's see the diagram. So manufacturer in a country A, it's let's say in Germany, then it automatically purchase the item from a company D. So it's a purchase of goods, then payment of goods to the Germany, then it is already imported. That means a distribution of goods, delivery through a free zone, designated free zone. Then from this designated free zone, then it has moved to a mainland company, that retail distribution, not an end user. Again, it is a not an end user. So if you are selling any items to a mainland companies, if it is an end user, then you will not be eligible for 0% city. So here it is like it's the goods are already moved to the designated free zone, routed through designated free zone, then from designated free zone to mainland company, but it is not an end user, that B2B transaction, then automatically you'll be eligible for 0% city. Company D conducts activity in or from designated zone. That means in or from designated zone, entering in a goods are entering in the UAE and imported through designated zone, and company D is performing a qualifying activity. So this is like importing of goods. So if it is importing of, if it is the company is not in a designated free zone, then it is not a qualifying activity. Company E is a free zone person, is a designated free zone person in a designated zone that buy goods from a juridical person in a UAE outside free zone. The goods have been either manufactured in UAE or imported into UAE by another person. Company E sells the goods to retail distributor outside the UAE. Company E earns a profit on the goods sold to the retail or distributor. The goods are shipped to the manufacturer or importer in the UAE in the retail or distributor outside the UAE. Whether company E qualify as a qualifying free zone person for city purpose. So in this scenario, company E, it's in a JAFZA, let's see JAFZA designated free zone, and the manufacturer, it is located in a mainland company there, and purchase those goods. So instead of purchasing, importing into JAFZA free zone, what they told, it is like a company E told directly from manufacturer to directly to another retailer that is in China. So in these cases, importing is not happen, but it is directly from there to directly going to the China. The goods do not pass through the designated free zone. Still, you will be eligible for 0% city, but all other conditions must be satisfied. That the condition like goods purchased locally. So these goods has been purchased locally. Either it is a manufacturer in the UAE or imported from the imported by another person. Second one is it's a goods, the free zone company. It is a designated free zone. Then substance in the free zone used to maintain. Then sale happened, B2B transaction, and KYC of the customer you have to maintain. Then it is not an end user. All these conditions are satisfied. Then automatically company E will be eligible for 0% city. So the goods or material are shipped or transferred directly by the manufacturer or importer to the retail distributor. So directly by manufacturer or importer by retail distributor without passing through designated zone. Without passing through designated zone, then automatically E conducts the activity from qualifying activities. Distribution of goods or material. Another example, distribution of goods or material within UAE. Company F is a free zone person. Company F is a free zone person in a designated zone that buy goods from a juridical person in UAE. So again, it is buy goods from a juridical person in UAE. The goods have been either manufactured in the UAE or imported in the UAE by another entity. So it is manufactured or it is imported by somebody else, another entity. Company F sells these goods to a retail distributor in the UAE outside a free zone. That means automatically another location outside a free zone. That means it's a local, mainland to mainland. The goods are shipped or transferred by the manufacturer, importer in the UAE to the retail distributor in the outside to the free zone. That outside the free zone, that means from Dera to Karama. So if you are moving goods without passing through a designated zone, but still you will be eligible for 0% provided that all these conditions are satisfied. So purchase has been happened by company F, but you are instructed from the manufacturer that directly transferred these goods to the another location in UAE itself. Still, you will be treated as a qualifying free zone. So qualifying income, it's a sale of goods. Here it is a sale of goods. Sale of goods has been done, but it is without touching through the designated free zone. Still, you will be eligible for 0% city. So company F conducts its activities in or from designated zone, and the goods are already in UAE at the time company F purchased them, so they do not need to pass through designated zone. When they are subsequently sold to retail distributor, company is F is considered performing qualifying activities. That means while importing or manufacturing, it's already there in the UAE. So it is routed through designated in the initial stage, or it is manufactured in UAE, then no need for again routed through the designated free zone. Now activities relating to logistics services. So what exactly logistics services? Logistics services involve storage and transportation of goods or materials on behalf of another person without taking the title of the goods. So that main thing is that you are just courier services or carriage logistics services, include cargo handling, warehousing, container storage, then customs brokerage services, order and inventory management, freight forwarding, document preparation and packaging, and unpacking, etc. Then last mile delivery services provided outside a free zone from a part of qualifying activity. Last mile delivery means a final phase of delivery process. If you are doing a final stage, you are doing a last mile delivery, then still it is treated as a logistics services. Logistics services do not involve movement of people. It's only the goods category, not movement of people. So it is a logistic company. That means a shipping and receiving, warehousing, packing, or order fulfillment in the free zone. Then that last mile delivery is also a part of the qualifying activity, or income from the transportation of goods or materials, then it is treated as a qualifying activity. So whatever the logistics service is done between the free zone, or it is free zone or foreign, then it is treated as a qualifying activity. Even if you are doing it within the free zone or mainland companies, still it is treated as a qualifying activity. Why? Because if you are doing any transaction with the mainland companies other than the free zone, then if you are doing a qualifying activity, then automatically you will be eligible for 0% city. So what exactly the condition? It is saying that qualifying activity, if you are doing any qualifying activity, it should be if you are doing with a non-free zone person, then it should be same out of 13 qualifying activity, one of the activity must be carried out. So logistics service, if you are doing to the mainland companies, still you will be eligible for a 0% city. There is no limitation in the mode of delivery. So whatever the mode, then there is no limitation. Company F is a free zone person in a logistics service provider with its business operation in a free zone during the relevant tax period. Company F has rendered the following services to customer company R: a non-free zone person, a clothing retailer. So transport and delivery services, it is like a 50,000, then warehousing, 3 months of 15,000, and order fulfillment, then 20,000, then freight forwarding, international shipments, 10,000. Then so the company F is a free zone person, then logistics services to goods and people, then payment of service, whatever the non-free zone person, then this activity, all the activities are conducted a logistic activity, then automatically they will be eligible for qualifying activity and eligible for 0% city. So we have completed all 13 qualifying activity, and we have discussed almost 27 examples with each qualifying activity with industry wise with a detailed analysis. So what's next relating to? So if your industry wants to review your business structure or business model or transaction before filing your first return, please send your queries to rbs@rbsaccounting.com or info@rbsaccounting.com. So because before filing of this your return, you must be ensure that all categories, like whether you are eligible for 0% or 9%, you have to ensure that. Otherwise, what is the impact like that? If you are giving like a qualifying free zone option, and after filing of the return, the FTA come to know that it's not a qualifying free zone, then the entire that year plus next 4 years, you will be disqualified as a free zone person, and you will be paid tax based on the total income. That means you will not get any 375,000 up to 375,000. That deduction will not be there. Straight away, whatever the net profit is coming, 9% tax you have to pay. So it is better to have a review, or better to have a clear-cut understanding before proceeding for any of the return. So RBS, our business model works like through, it's like a workflow model, and we have a separate portal, RBS portal, and whatever the work it will be discussed between the client and the RBS assigned RBS staff, and you can interact directly with the client and the staff, and whenever any issues, then it will be directly notified. So it will be a smooth flow of the operations, and the client can even client can see what stage of work it is going on, what is the stage. So a clear-cut interaction between the portal, so you will get an idea. It is all app. It is already available in a Google Store and App Store. So once you are on board our client, then only you will be able to access all other services. Otherwise, you can just see, even you can send a request to the portal, then we will get assigned to the respective team. And we are already present in all social media channels, that YouTube, LinkedIn, then Facebook. And even if you have any queries or anything, you can just send a mail to RBS or info@rbsaccounting.com. And we have already a webinar we are already posted. Then you can just go through those things. Then you'll get a clear-cut idea about each area-wise. We have already presented transfer pricing, then some other areas relating to free zone. Thank you once again for joining our webinar. We'll come with the next webinar updates through our social media, and you can give your comments, feedback, and everything through our Google review. We have already posted a Google review. You can see in our message in a Google review. You can just give a Google review about this one. Until then, goodbye and have a wonderful evening.